Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I'll be your host today. And really excited to have a friend of mine, Brian Tibbs, on with us again today. Brian was with us on episode 191 just over a year ago, but wanted to touch base with him because there have been some exciting changes in his business and some new announcements. So Brian is the CEO of My Short-Term Home, and he also authored the book Method. So Brian, welcome back to the show. Glad to have you back with us.
Thanks, Randy. It's great to be back with you. I'm excited to pick up the conversation from where we left off.
Yeah, very good. Well, let's jump right in if we can. Can you give us your perspective on the current state of the economy and the market and how it might be impacting passive investors?
Yeah, everybody wants to know what's going to happen. And you hear this question all the time. And everybody says, well, I don't have a crystal ball. So I'm not going to say that. What I'm going to say is I operate with a thesis. I update that thesis as the world changes, but to not be willing to try to guess where the hockey puck is sliding, I think means you're just going to sit on the sidelines and you're not going to really ever take action. So my thesis is now, do you want to talk about the global economy, the American economy, or the housing market, or where do you want to focus?
Anything you'd care to focus on, honestly. This is your chance to share what you'd like.
I think the macroeconomic environment, at least in the United States, is maybe a little bit soft, but not in a recession risk. I just don't think that we're in a recession risk. We have a new administration, the Trump administration, whether you love him or you hate him. We actually do have the benefit of being able to look back at his policies 8 years ago and asking ourselves, how did the world economy perform then? Yes, we have evolved as an economy, as a world. There's new conflicts, there's new challenges, but we got the same sheriff in town. And so the best we can do is, and he's talking about tariffs and he's talking about the same stuff he was talking about last time. So how did things perform last time? And let's set that against what we're looking at right now. We probably are not in the situation where the market is going to do as well. This is my opinion, right? This is my thesis, as it did in 2016 to 2020, taking COVID out of the picture. But I don't see we're heading into a recession. In terms of the housing market, like the national housing market, kind of all the predictions out there is we're going to see somewhere between a 1% and a 3% appreciation this year. Nobody knows what's going to happen with interest rates. And I have retired from the business of predicting interest rates. That said, if interest rates come down, I think we'll be on the higher range of that 3, maybe 4% appreciation this year, because we've had 3 years of like this stagnant housing market. Some markets grow, some markets slide, a lot of flat lines out there. I think there's pent up demand. I think there's people that want to form a household. I think there's people that want to buy a house, and they've just been like 7%, no thanks. And so if we can crack below that psychological 7% number, get to the 6.5%, I think that that's going to bring buyers into the market, which is going to push prices up modestly. So that's my thesis. In terms of investing, I'm always buying. I'm always investing. I'm looking at the market. I'm assessing my thesis, and I'm making decisions based on that. I'm not one of those guys that just sits on the sidelines. Well, when interest rates are 4% again, I'm going to jump in. I think that means you're going to lose a decade.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Yep, I love it. Yeah, so the theme that I'm hearing is at a very high level, you're generally optimistic, maybe not as optimistic as we might have been 8 years or so ago.
Yeah.
And what I'm hearing kind of loud and clear is this idea that there are opportunities to invest and do well in any market.
Yep.
And you might need to get a little more creative. You might need to, basically pull your bootstraps up a little bit and work harder and find those deals. But it sounds like there's always opportunity out there is what you're saying.
Yeah, it always cracks me up. When interest rates were 3%, everybody was complaining, I can't get any deals because there's 30 offers above asking. Well, and now everybody's complaining, I can't get any deals because interest rates are 7%. Okay, you got to, pull yourself up your bootstraps, figure out how to get in there and make something happen. There's always challenges. The markets, there's a sliding, it's like a teeter-totter. Either rates are low and money's everywhere and there's no deals to be found, or rates are high and there's no money to be found, but deals are everywhere. And this you got to assess where you're at, try to find a strategy that's going to work. For me, real estate, it's one of those things where we have a very long track record over long periods of time of values rising, right? If you're trading homes like stocks, yeah, you can get in trouble. But if you're a long-term buy and hold investor, you don't have to be that smart or that creative really to do well. That's just a reality.
Yeah, I think Jim Rohn has a quote where he says, if you're out there looking for believers, you're going to find non-believers and you're going to find believers. And we can spend our time trying to convince the non-believers to be believers, or we can just go find more believers. And there's plenty of believers out there. And I think it's true. Like in any market, people are always going to complain about something. But the top performers, the superstars, the guys like yourself and the guys that we like to hang around with, they're always going to find opportunity no matter what we throw at them. So, yeah.
We're like water going downhill. We're going to find a way to get to the bottom of the hill.
Absolutely. Absolutely. Well, let's, I know you've been on the show, and as I mentioned, it was 191. It was about a year ago. For the listeners, definitely go back and listen to that. But for the folks that...
a year already.
I know sometimes it feels like it was a couple of weeks. Other times it feels like a decade ago, but yeah, no doubt. But can you give the audience just a very high overview of your background and your experience and how you got to where you are? Clearly you didn't just show up one day and be a master at short-term rentals. So let's hear the Reader's Digest version if we can.
Well, first I would still say I'm a student, always trying to figure this out, literally every month talking with our team. All right, how do we get our scores up? Okay, how can we get our average daily rate up? Okay, how can we get our optimized occupancy? So we're still learning, trying to figure out how to do this business. I bought my first duplex when I was 19. I grew up in a business ownership family, and so not necessarily real estate, but I just kind of had in my mind that everybody I knew that was wealthy owned real estate. So I want to own real estate. And so that was the extent of my sophistication when I started. So I bought a duplex, brand new from a contractor, paid the absolute top possible price, right? And that started my journey. I actually moved overseas and was the CEO of a nonprofit for 16 years, not making very much money, less than minimum wage, actually, where I live now at least. But I still was slowly building my portfolio over the years. When we finally retired from that, we moved here to Phoenix, Arizona, and are now focused 100% on growing our portfolio. And we now have 45 units total in the Boise, Idaho market and the Phoenix, Arizona market. And they're all short-term rentals, with the exception I just invested in a sober living home project with a friend of mine from way back. And so we're dipping our toe, I guess that would be considered co-living essentially. So we're dipping our toe into that asset class, but he's the manager of it. I don't manage it. I'm more of I'm an active investor, but I'm leaning on his expertise.
Love it. Love it. Okay. So yeah, really long journey. And again, I want to encourage folks to go back and listen to the conversation that we had a year ago, because Brian has an amazing story. He is the go-giver. He gives incredibly and has brought so much value to the group, or to the world, honestly, over the last couple of decades. Certainly worth the listen, but I really want to dig in and focus on the short-term rental space, because this is a great asset class. Impact Equity, my company, has invested very heavily in that space as well. And there's a lot of changes going on. So you mentioned, a couple of things, like you're constantly trying to drive ADRs and reviews. So maybe if we do that, can we just talk a little bit about the metrics that are really important in this space for the folks that are newer to the short-term rental space?
Sure. So, Airbnb is still the 800-pound gorilla in the market. They get about 55% of our business, and that's with us trying to shrink that number at every possible chance. Not because we hate Airbnb, but because we don't want to be so reliant on just one source of revenue, right? And so anytime we can kind of slice that pie up, we try to do that.
And can we dig into that a little bit too after the metrics?
Sure.
Because I'd love to hear how you do that. Okay, perfect.
Yeah. Well, I'll just dip into that. So 55% of our bookings are from them, 25% are from Vrbo, 10% are booking.com, and the rest is from some smaller sites and our own website. We're really trying to get our own website. It used to be 30%. We actually had an on-staff salesperson. This was back in the days when you could sign up insurance companies, but now it seems like they all go to Airbnb directly because they figured out we can get it for cheaper going that route. So our 30% slid down. Now it's about 8%, and we're trying to drive that up as much as we can. Yeah. So then the other metrics that we look at. So I think occupancy for us, now there's people that will argue with me and they've got great arguments. So I'm not going to pretend that like I've cracked the code. But we really adjust our pricing up and down to try to achieve an 80% occupancy. Our thesis is if we're above 80%, we're not charging enough. If we're below 80%, we're charging too much. And so we try to adjust. Now we have minimum pricing, and if it gets to the minimum pricing, we're not going to go any lower than that because that brings some additional challenges. But our lifetime occupancy is 81.5%. And we constantly just adjust and tweak to try to push it to 80%. It's kind of like you never want to run a factory at 100%. You need some slack. The machines need to shut off once in a while. Just need some slack in the system in order for things to run optimally. And that's where we've pegged it, is that 80% number. And so our ADR really follows that. Rather than us saying, doggone it, this thing's worth $190 a night. Well, not if it's not getting booked.
Sure.
So I remember my grandfather had this land and he was convinced it was worth X dollars. Well, it sat on the market for 4 years. It's only worth what somebody's willing to pay for it. And that's the same thing as short-term rentals. If it's not renting, it's because your price is too high. So we mess with that to try to achieve that 80% number.
I love it. Okay, so ADR. And what is your ADR? Just curious. Do you have like a lifetime number or does that fluctuate as well?
So last year, our ADR across the whole system was, I think, $108 average per night. Now, we have 4-bedroom homes. We have homes in nice neighborhoods, and we also have economy studio apartments. And so that's all of that thrown in, all that averaged in is about 108. I think this year is going to be a little bit higher. We're trending up about 6-7% so far this year compared to the same time last year. So maybe over 110 this year.
And is there also like an average length of stay, or is there like a average ticket price that you follow as well? Because I would imagine you want people to stay more than one night.
Yeah.
So I'm curious what that is.
So again, our philosophy, some people try to make money on cleaning fees. We just try to break even. In fact, we just lowered some of our cleaning fees because we were making too much. And my theory on that is we're not going to get the 2-night. I mean, a 1-night stay, we'll take them in certain situations, like if something's not booked. So our system will allow us to make changes to our policies if it's still open 7 days from now. We'll allow a 1-night stay during the week. So we'll take a 1-night stay, but we're totally fine with a 2-night stay because that cleaning fee is just offset. The cleaning fee offsets the cleaning expense. So if we get it booked, and again, we're trying to drive that 80% occupancy. 1 night out of 30 makes a big difference on that. And so we're okay. We're okay with a shorter stay. Our average, I haven't looked for last year's average, but it's been historically about 4 to 4.5 nights per booking. So that's what we've averaged.
Interesting.
So
okay.
The reason why I don't know how that stacks up with other folks, but we have some of our economy units that will book for 30 days. And so that stretches that out. And then we got people who book for 1 night as well. So
yeah, it's an interesting space, and there's all shapes and sizes. And I know there's been a lot of changes, from my understanding, to the platform requirements and what they put an emphasis on. Can you talk a little bit about that as well? Yeah.
Yeah, they don't publish what they're looking for, which, I just had my meeting with my quarterly rep at Airbnb, and she's like, yeah, they're not going to publish it because they don't want people to game the system. And I'm like, and my kickback on that is, do you want us to provide what you're looking for or not?
Right, exactly.
if you would tell us what's the most important to you, we can focus on that. So anyway, she doesn't know for sure, but what she was telling me is, and this makes sense, the number one factor is the quality of the product. What's your review score and how many reviews do you have? Right after that is price. They're determined to get your price as close to zero as they can possibly get it. And so, they're trying to get you to do all these discount schemes and all this kind of stuff to get exposure to their algorithm. So we're maybe going to play with that a little bit, but we have our strategy and we're not going to let what they want, which doesn't line up with what we want, to dictate that. So driving the reviews scores higher, that's the one that we want to focus on. We want a quality product too. So it's nice to have that partner that really kind of sets these bars so that all of our staff knows this is where we're trying to hit, right? We're trying to hit Superhost all across our platform, not just in each city where we're working, but on each property as well. We want them all to have high reviews because that drives future bookings.
And what is it that's driving, what are the biggest levers that drive positive and negative reviews as well?
Yeah, this is one of those things where it's part science, part art. As a larger operator, it's tough to compete with that 45-year-old housewife that doesn't have anything to do but make sure her unit is perfect every single time.
Sure.
That has 4.9 stars, right? And will always have 4.9 stars because she's a personal friend with every guest that stays. We friendly. We try not to feel like a corporation, but we are. And we got to turn their cleaners, and we got to kind of cookie cutter some stuff. And so we have some challenges with that. But we're always trying to. So we have two things that we say internally and to our guests. We're going to provide lightning fast communication. We can't promise that you're not going to have any issues, but we will respond immediately. And so we have staff that's literally on standby waiting for messages to come in from 8 o'clock in the morning until 9 o'clock at night. And they're going to get a human being to respond our goal is within 15 minutes, but whenever possible within 5 minutes. The second thing is if you don't feel like your stay is a 5-star stay, we'll do whatever we can to make it right. Now, yeah, that's our stance. This is getting into the weeds a little bit for operators. We have a no refund policy. We've been burned too many times with people who are trying to game the system to get a free stay. We've even had people change our sheets, put stained sheets on our beds, take pictures and send them to Airbnb and say, this is disgusting. Like there's blood on my sheets. And we know what sheet brand we buy. That's not the brand we buy. And so we're able to fight that. But basically, because of those bad apples, our internal policy is, unless there's some extenuating circumstance, no refunds. But we'll send the cleaners back out. We'll send the caretaker out. We'll fix the pipe. We'll do this. We'll do that. We'll buy a new lamp. We'll do a lot of things to try to make your stay a 5-star stay.
I love it. Yeah, no, I've heard a lot that there's a lot of folks that try to manipulate the systems, and that people are doing it pretty regularly and taking advantage and getting free stays. I'm curious, what does Airbnb's stance look like at that? Do they favor the operator or the renter, or what does that look like generally?
Tie goes to the guest every single time.
It does. Okay.
They do have certain policies, and if the guest will violate a policy, then the host can win an argument, but it's still a judgment call by the agent. And if the agent decides, no, Airbnb can send a refund without our permission, even if it's the last day of the reservation, they've been there for 10 days and all of a sudden they've got all these problems. If they decide, then that's it. You're toast.
Interesting.
So now there's ways to fight it and there's ways to go, but it's like dealing with the government. It's rough to try to get something appealed and overturned. And so our staff spends a lot of time dealing with that, which is why, again, we're trying to diversify where our reservations come from and drive them to our.
No, I think that makes a lot of sense. And I've heard about this trend towards quality and favoring the renter as well or the guest. Is there new trends in municipalities and some of the approval rates and whether you can and can't do these in cities? That seems to be kind of one of the biggest objections I hear from people is, well, cities don't like this.
Yeah, there's a couple ways to look at that. And yes, the market figures something out, short-term rentals, then the government comes in behind it and tries to regulate it or control it or ban it or whatever. I'm in two markets where the state legislature has passed laws protecting homeowners' rights to do short-term rentals. And so the cities in both Idaho and Arizona, where I have units, are not allowed to ban short-term rentals. They're allowed to regulate, but they're not allowed to ban. And so that's why we decided to invest in those two cities in short-term rentals anyway, because we know, I mean, the state law could change. So we have a contingency to where we can flip to a long-term rental. We can still rent all of our properties as long-term rentals and pay the bills if something were to happen. But our first strategy, obviously, is short-term rentals. So the other way to look at that, other than looking at like, yeah, they're cracking down, it's not a good environment. For us, we have staff, we have procedures, we have policies, we pay the registration fees, we follow all the rules. And so we kind of feel like maybe we have an advantage over maybe a less sophisticated, like one-off operator that's like, it's just so much work and it's this $250 per year fee. So we feel like if we can just conquer it, do what the city wants us to do, then we can execute, right? The other way to look at it is if you're in an area where certain Airbnbs are banned or you have to be grandfathered in or something like that, that's actually an opportunity where you can use regulation to your advantage because it's artificially keeping the supply low. You know, like there's some places in Hawaii where it's very short-term rental unfriendly. If you can figure out how to get a license in that environment, it's guaranteed cash flow. So there's, again, if you're an investor, you got to be kind of like a tiger in the weeds. Where can I make an opportunity here where everybody else is like, it's banned, it can't be done, or the Airbnb bust? That's my favorite line. Get out of the market. I'm staying. Get out.
Yeah, challenging markets make it easier for guys like you because the less sophisticated investor goes running. Definitely.
Yeah. Because they want that passive cash flow that's just going to come in like crazy. When you realize that the way economies work is there's a supply and demand force, and it's going to force out the weaker performers because they can't provide the product that the customer wants. So you just got to knuckle down and you got to bear through it and wait till all those kind of like as-rans get out of the market, and then you got the market to yourself.
I love it. And it's interesting. I was working in financial services space back in 2000. When things got tough, we saw a lot of people get hurt there. But the people that made it through those challenging times got to take advantage of everything going up after that. And we're starting to see the same thing in this space as well. Like multifamily got tough, so people flee to other markets. Those things get tough, people flee. Short-term rental, everybody flee. It was going there because everybody was making tons of money. Now it's getting hard and people are running. So groups like yourself and some of the other more sophisticated operators will be able to continue to refine their business systems and processes. And on the back end, when the economy starts to shift and everything starts to look more positive, you guys will be able to be there and take advantage of that, where the others will be either sitting on the sidelines or chasing the next pretty thing.
Yeah.
Well, let's go ahead if you had something to add there, for sure.
Yeah, something you touched on, I think, is something that's really important for your audience. Is short-term rentals the highest cash flow producer in real estate right now? Probably not. There's other strategies that are better. And I'm saying that as someone who is trying to get investors to come onto my team. But my entire business is built around short-term rentals. We know the industry, we know our markets, we know what our customers want, and we're trying to get to that really professional level. If you, every time there's a new asset class that performs better than what you're doing now, if you flip to that every single time, I don't know if you're going to make any money, because it takes a long time to master a craft and to understand all the things you didn't understand when you jumped into the market. I mean, when I first started doing short-term rentals, oh my goodness, what an embarrassment. It took time to figure it out, to build out a team, to build systems, to get good at it. And so I think that sticking true to what you're good at over a long period of time is going to be more productive and more profitable than jumping to each new asset class that is performing better in the new.
Was it Michael Jordan that talked about the 10,000 hour piece where you need to have 10,000 hours before you have expertise? And 10,000 hours, at a regular 40-hour a week, that's 5 years. Now, at the entrepreneur space, that might be 3 or 4 because you're clearly probably working more than 40 hours. But I think there's something to that. And yeah, I think time will show us what it showed us time and time before, that the people that stick with one item without getting distracted by other things will be the
Yeah.
people that are performing on the back end. So,
Yeah.
well, we've talked about a lot of the challenges, and because my mind as a capital allocator, I go to what can go wrong. So I want to dig into
Yeah.
the negative, potentially negative things. Let's talk about some of the positive trends. Why should somebody be excited about short-term rentals, and why it could be a good place for them to hold some or a portion of their capital?
For me, that comes down to a very simple calculation. I like single family homes. I understand the argument for commercial real estate, although right now that argument is harder to make than it was maybe 5, 8 years ago. I just like single family homes because I love the idea that I can throw it on the market and 30 days later have an offer, and 30 days after that, I'm out. So I like that aspect of the single family home. Single family homes have a pretty predictable growth rate over time. And if you can leverage that with appropriate amounts of debt, I mean, you don't have to be a genius to make money in owning single family homes. Okay, so owning single family homes, what are the ways that we can generate cash flow from that? You can do a traditional rental, you can do a short-term rental, you can do a mid-term rental, you could do a co-living rental. So those are the ways that you can use it. Short-term rental is the business that I've developed that I know, and it makes more money than a traditional rental. And so at least the way I've done it, I mean, some people have flipped back to traditional rentals, and I scratch my head. I'm like, it makes more money than a short-term rental. So it just makes more money. So that's why I use the short-term rental market. I also think on a bigger scale, it's proven that every year the demand for short-term rentals versus maybe a hotel is growing. The audience of people comfortable renting a home versus a hotel is growing. And so when you're in a growth trend, then there's opportunity for you to get in and capture some of that market share. If it were sliding, be a new story. It's time to look at maybe a new asset class.
And that's a good point too. I know when I first started looking into kind of institutional or large operator short-term rental, the exit strategy, at least presented at the time, was, yes, we can just sell these as SFRs to regular investors or to the end user, or there's this institutional play where private equity could come in and buy these in volume. What are you seeing in that space? Are those type of transactions starting to occur or continuing, or what is your take on this? What is the exit strategy, I guess, for yours?
Yeah, I've even seen pitch decks that are saying that that's their exit, but I've never seen it happen. Not saying that it hasn't. I do have an eye out on it because that would be appealing to me if I could get more than market value for my homes because I have this business built around it, which makes total sense. Of course, I would sell the whole package versus selling each individual house off and pay the realtor 6% and blah, blah, blah. Of course, I would do that. I mean, I'm not saying I'm in the market to sell right now, but if I were, that would be more appealing. I just haven't seen it happen. And I don't know why that's the case. Maybe it's something that's just so new that there hasn't been a big group that has decided this is what we're going to go do. Or maybe I'm just missing it and I haven't seen it. It is happening. Have you seen it happen?
You know, I've heard that there are discussions around potential acquisitions, but I've not heard of any actually occurring. So
yeah, that's the same for me. And if I had to answer as to why, well, it's not that difficult to furnish a house and get it photographed and put it onto the system. I mean, I say that, and as I'm saying that, I'm like, yeah, but you don't know the other 1,000 things that have to happen
Sure.
in order for it to be successful.
Sure.
But it's not, I guess the barrier to entry is not enough for somebody to pony up a 10% premium or a 15% premium. They'll just say, we'll just buy our own portfolio of rentals and convert them. I don't know. I don't know why, but it does make sense.
And I think private equity writes generally will write bigger check sizes as well. So it has to be a really, really large portfolio to even
Maybe
get
that's
on the
why
radar,
we haven't heard of it. Yeah.
Yeah. Yeah. Interesting. Okay. Well, now I think since you and I actually had our last episode, you wrote a little book or something. So I think I've seen some notes out there. Can you talk a little bit about that?
Yeah. So I wrote The Hacker Method. Actually, it came out February 27th last year. So it's just a little over a year ago.
Okay.
That book was when I came back from the nonprofit work. I had people, well, what are you going to do next? And it was kind of hard to explain that, well, I'm kind of retiring. I've got this investment portfolio. They're like, what? And many people were saying, how did you do it? And could you teach me? And I was like, I've never said it out loud. I'm not sure. So I decided to sit down and write it out. Like, what did I do? How did I do it? And the whole goal of the book is to help folks who want to get out of the paycheck to paycheck trap. Maybe they don't make a ton of money. I made poverty wages and still was able to build a multi-million-dollar net worth. And anybody else can do that as well. Now, I know your audience is maybe a little bit past that level, but maybe they know some folks in their life that's on that hamster wheel and they don't see any way to get off of it. I've actually started, after the book, I started a community called the Unexpected Investor Community, where people who are wanting to get out of the paycheck to paycheck trap come in. We do coaching, we do one-on-ones, we have small accountability groups. We teach on new concepts of how to view money and how to use it. And people are really growing. And my goal is for them to all turn into multimillionaires. If there's anybody out there that knows somebody that might be connected, you can go to my website at theunexpectedinvestor.com/community. Have them check it out.
Love it. I think and it's not just the people that are just getting started or in the middle of the pack. Like, this type of process can work for anybody. And like when I started Impact Equity, my goal around all of this was to help the W-2, the high income W-2 employee decrease their dependence on that W-2 income. Yep. And your strategy marries perfectly with that. And it's whether you're a 22-year-old getting out of college who's got their first job, or somebody in their fees like I was looking at, like, I'm 15 years away from retirement and the 401k is not measuring up to where it should be. You've got to do something different. And to the listener, like, Brian has done this and he's so skilled and trained at teaching other people how to do this. He's just an amazing resource for that. So I would encourage you, really anybody listening should reach out and buy the book at a minimum and take a look at his community as well, because I think it can bring just a ton of value to you. There it is. Yeah.
Yeah. The hacker method.
That's not a little skinny 50-page book either. Like, there's some real solid content in there. You see a lot of people that are number one best-selling authors of little tiny books.
Yeah.
But I know you put a lot of time and energy and effort into that. So good stuff. Well, it seems like the clock always runs faster when we get a really entertaining and educated and talented person on the phone.
And long-winded.
We are there. No, it's good. This is a conversation I was looking forward to have, because I've been fascinated with the space. I've invested in the space. I always want to learn more about it. And you're the guy to learn from. So,
thank you.
If you do have a few minutes, though, I do have our final 5 questions I would love to dig into if we can. So I know we just talked about your book, but are there other educational resources that you would suggest to folks that are interested in investing in the short-term rental space so they can just continue their education journey?
Yeah, short-term rental, there's a lot of nonsense out there, to be honest with you. And I check it all out, and I usually say, yeah, this person doesn't know what they're talking about, or their thesis is just so different from mine that it's not relevant to me, maybe relevant to somebody else. And I'm gonna say a podcast. It's called Thanks for Visiting. It is the opposite of their demographic. Their demographic is women that have 1 or 2 units, right? So it's that lady that I'm talking about that I'm competing with, that straightens out every corner of every pillow herself, and just does a superior job to what we can do as a company. That's their market. But I will listen to their podcast on occasion, because they've had some really good tips that I have put into practice that has changed my business for the better. So Thanks for Visiting is a podcast. It's 2 ladies that are focused on women, but they really are hosting. And I actually had a couple of my staff go through one of their boot camps to do listing optimization. So I do feel comfortable with those 2. In investing in general, I love the All In podcast, because they are so far ahead of where I'm at. They're all billionaires and they invest 10 million minimum, 100 million often into different startups. And so they are stretching my thinking. So I like that podcast as well. They're not short-term rental focused, but they're more like startup focused. But I have to learn new terms and I have to keep up with those guys. And so I like
Yep. No, I'm a big fan as well. It's interesting. They don't always publish on the same day. So I'm quite often wondering, like, when's that next episode going to come out? Because it is on my weekly listening for sure. So, well, very good. Well, you kind of answered 2 questions there. So we'll jump into our due diligence question. For folks that are trying to continue to refine and improve upon their due diligence process, what is a good due diligence question they should be asking as a passive investor that maybe isn't one of the normal track record or how long you've been in business? Like, are there deeper questions they should be digging into in that process?
Yeah, On this last round, I was talking to a guy that was really kind of helping me put together my pitch deck. And he said something that was really profound that changed the way I was going to present my information. He said, okay, you're looking for $100,000 investors. So you need to put a slide in that shows, if I put in 100,000, what am I going to expect based on these projections over the course of the fund and why, and back it up. And I was like, oh yeah, that makes a ton of sense from the user standpoint or from the investor standpoint. Lay it out for me. Don't make me go to the P&L and crunch numbers and figure this all out. And so I thought that was great insight. And I actually led with that in most of my discussions. So, okay, if you put in 100,000, this is what I'm saying we're trying to accomplish. And it was a very easy conversation from there.
Yeah, I love that you say that, and that's actually something I include in all of mine as well, because my very first investment that I did, I didn't know the difference between preferred return and cash on cash.
Right.
Shame on me. I should have known that. But when that first distribution check came and it was significantly less than the cash on cash or the preferred return, it got my attention. And I just always think like, what can we do to present this so there's no shock and surprise for investors? Right. Like we want them to know exactly what's going to happen. And I like how you also said, why is it doing that?
Yeah.
That's a really, really important piece. So thank you for that. Great question for them to be asking.
In fact, I had one of the investors like, well, if the IRR is this, why is the first payment so much smaller? And fantastic. So now we can dig into that and explain, well, we have reserves. Some of that IRR is wrapped up in equity. We can't cash that equity till we sell the building. So it was a great way to go through that conversation.
Love it. All right. Well, let's wrap it up with a couple of fun questions here. You and I are both involved in GoBundance, and there's a lot of talk and a lot of attention around bucket list items. So do you have a recent bucket list item you've checked off your list or one you hope to in the near future?
Well, the biggest one in the last year was the book. That was on my vision board forever. And the day it published, I got to take it off the vision board and replace it with something else. The other thing is I'm a CrossFitter. That's one of my hobbies to stay healthy, and I actually enjoy it. And we're right in the middle of the Open right now, which is the global competition where anybody can sign up and register. And my goal for 2027 is to finish in the top 25%. Well, my first workout, I finished in the top 19%. So I might be able to take that off my bucket list this year. So we're going to keep focused, eat healthy and lean, and stay in the gym until this is all over.
I love it. Congratulations. We'll definitely be rooting for you. I look forward to hearing how that goes.
Appreciate it. Yeah, thanks.
All right. Final question. If you had $100,000 you had to invest today and you couldn't put it into one of your deals, where would you put it?
Yeah, so this is my answer to this is genuine. I would find a friend that is trying to get something going. Now, they need to be competent. They need to know what they're doing. But I would want to support somebody who's trying to get started and just doesn't have the capital. So whether that's a young person that's got a lot of energy and drive and passion, or somebody who's trying to get out of the rat race. So that's where I would put it. I wouldn't say this is this asset class or that asset class. I would do due diligence, but I'd want to help somebody coming up.
Love that answer, Brian. That's amazing. And it really just kind of ties back to who you are as a human. So yeah, great answer. Yeah. Thank you. Well, very good, Brian. This has been fun. Part of me, I was thinking, gosh, I've had Brian on. We've talked a lot. What are we going to talk about? But you brought so much value today. Thank you so much.
You bet.
We'll have to do this again in a year.
Yeah,
exactly. Absolutely.
Yeah, for sure. Love to.
All right. Well, very good. Well, to the listener, as always, we encourage you to continue that education journey around passive investing. But more important than that, we encourage you to make the decision to invest in your first or your next passive investment. Both Brian and I are convinced that once you do, you'll just wish that you had started that much sooner. So be sure to join us again next week for another great episode. Don't forget to like and subscribe wherever you're listening. And thank you so much for joining us here today.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.